Good afternoon, everybody. Welcome to the conference call. I'm Greg Sweeney. Our fourth quarter outlook will cover a similar format that we've done in the past, take a couple of topics, talk about their potential influence in the economy and the markets. You might expect me to start out on my first slide with the recent Fed rate cut, but I'm going to jump right to election year returns in the stock market. We get a lot of questions about how the stock market might perform based on the results of the election. You'll notice that there's very little consistency or correlation between the party in office and the performance of the stock market. Instead, what I would like to do is direct your attention over to the left side of that screen, particularly the bottom two lines. The average return in all election years is about 11.6%, and the year following an election, 10.7%. Both of those are above the long-term average market returns, which are somewhere between 9.5% and 10%. Bottom line is we're not looking to make any changes in investment strategy based on the potential outcome of the election this year, and instead electing to focus on the secular criteria in the markets rather than the cyclical criteria in the markets. Having said that, let's go to the Fed fund target rate. The market was expecting the Federal Reserve to reduce rates between 25 and 50 basis points. They did 50 basis points, reducing it from a maximum target rate of 5.5% down to 5%. And the market liked that. The stock market was up. Short-term bond yields were a little bit lower. Long-term bond yields, though, drift a little bit higher. We're going to talk about why that happened here in the next couple of slides. But as the case may be, it's not the size of the rate cut we think that matters, but what we feel matters more is where is the Fed headed. And we think that the Fed is headed in the direction of maintaining what we call a real interest rate cost for borrowers and a real interest rate of return for savers, which means that the Fed funds rate probably remains above the inflation rate. If the Fed is successful in getting inflation back down to about 2%, we expect the Fed funds rate to be about 2.5%. We think, though, on the other hand, that there's very little history of inflation being in that 2% range. We think long-term average inflation is closer to 3%. With that in mind, we think that the Federal Reserve probably lands at a Fed funds rate somewhere around 3.5% rather than 2.5% in a 2% inflationary environment. Supporting that would be the Fed funds rate in relation to the two-year yield. On your screen is a light blue line that shows the two-year Treasury yield against the darker blue line of the Fed funds rate. It goes all the way back to 1977. You'll see that the two-year Treasury does a very good job of predicting where the Fed funds rate will be. Right now, the two-year Treasury is at about 3.6%. That would be consistent with that number we've just been talking about, where the Fed fund lands somewhere around 3.5% in a 3% inflationary environment. If we look out a little bit longer on the yield curve to the 10-year Treasury, our assumption at this point in time is that the 10-year Treasury has gotten ahead of itself a little bit. We think the 10-year Treasury yield, at the time I did these slides, was about 3.65%. Today, immediately today, it's about 3.75%. On average, the 10-year Treasury yield is about 100 basis points or 1% above the two-year yield, suggesting the 10-year Treasury should be somewhere around 4.65% in this environment today, not the 3.65% environment. So we think that the 10-year Treasury might have gotten ahead of itself a little bit. Could I make an argument for the 10-year Treasury being at 3.65%? Yes. That argument would be that the bond market is expecting a tougher times in the economy, potentially a recession, and investors are willing to accept that 3.65% to protect their portfolio against a slowing economy and a stock market that sells off in a recessionary period. I don't think we're there yet. And the reason I don't think we're there yet is because corporate credit spreads, which would also signal the confidence that fixed income investors have in the economy, are very narrow. Narrow spreads are consistent with strong conviction that the economy will continue to grow. So I don't have any way to really support the idea that the 10-year Treasury is expecting a weaker economy moving forward. 30-year mortgage rates are usually a function of the underlying 10-year Treasury rate. On average, 30-year mortgage rates are about 200 basis points or 2% above the 10-year Treasury rate. And we're looking at 30-year mortgage rates that are instead about 300 basis points or 3% above the 10-year Treasury rates. If the 10-year Treasury was priced where I'm saying it should be right now, that would be 4.65%. The current mortgage environment would support that as well. So you can see historically how that looks, and you'll see that currently that's about as wide as credit spreads have been for quite some time. If we look at the inflation, this is a slide that I included last quarter. Inflation is viewed differently between economists and consumers. Consumers look at inflation as accumulation, right? Inflation keeps pushing prices higher and higher and higher. And products that we bought 3 or 4 years ago that used to cost $100 now cost $120. But the economists quote inflation on a quarter-over-quarter or year-over-year basis. And what used to be a 9% inflation rate is now about a 3% inflation rate. What that means to us as consumers is those products that used to cost us $100 that now cost us $120, at the end of next year, they're going to cost us about $123, $124. So the consumer views inflation quite a bit differently than the way economists view inflation, which is why it's very painful for us as consumers. Deficits, the consumer, and GDP. I started talking about the Federal Reserve and the 50 basis point rate cut. It's important to go back to why the Federal Reserve cuts interest rates in the first place, and it's because they see a weakening economy. If they didn't see a weakening economy, they would leave interest rates where they are. So historically, the consumer is about 2/3 of the U.S. economy. And those of you who are regular readers of my monthly outlook, you would know I've been talking about the consumer and how the consumer has been marginalized over the last few months, actually going on almost 2 quarters now. We're looking at credit card delinquency rates drifting higher. We're looking at savings rates being near record lows, at least over the last 30 years. We're looking at automobile delinquency rates drifting higher, and we're looking at jobs that are becoming harder to find. So I would say the consumer's been marginalized. It's been going on for a while now. The consumer is kind of trying to find their footing in the higher priced environment, and it's a struggle, right? But then we get GDP reports of GDP being up 3%. So how is it with the consumer being 2/3 of the economy, if they're being more marginalized and compromised in terms of their ability to consume, how is it that GDP continues to be up 3%? Well, what I did is I put a slide on here that shows GDP, gross domestic product, in relation to federal deficits. The federal deficit is the dark line, and the light blue line is gross domestic product or GDP growth. What we're seeing is deficit spending to the tune of about $2 trillion at the federal level amounts to about 6% of GDP. Could we say that the consumer is actually down 3% and the federal spending up 6%, which means nets out to be 3%? It's not quite that easy to do. Economically, it takes like $5 of debt to add $1 of GDP. So the math isn't that simple. But the bottom line is that we think that the federal deficit spending is masking the weakening consumer, but GDP is still showing a reasonably strong level of 3%, particularly when we look at that in relation to other foreign countries, developed foreign countries, whose GDP growth is only about 1%, but their deficit levels aren't nearly as high as they are here in the United States. The stock market has favored technology-type companies. On the slide, you'll see the light blue line clearly ahead of all the other lines on the graph. The light blue line is the NASDAQ 100 since the beginning of 2023, so roughly, 21 months now or so, doing much better. If $100 invested in the NASDAQ at that time amounts to about $180 today. The next 2 lines on the graph, the very dark blue and the pink, are the S&P 500 and the Dow Jones, performed very similarly with the Dow Jones catching up here in 2024, a little bit below the S&P 500 in 2023. And the bottom two lines are mid cap and small caps. Bottom line is the market has favored large technology companies. If I was to make this chart a little bit shorter and just show you maybe since July of this year to today, you would see the small and mid caps starting to capture more of that incremental return than maybe we've seen in the large technology-based companies, which means that the performance in the market is becoming more broadly based, particularly in the second quarter. We see that moving into the third, well, we've seen it move into the third quarter and moving into the fourth quarter as well. So in the end, summary, what does this mean for investors? Back to that election topic, the economy's natural state is to grow. Markets tend to follow that economic growth. Anxiety is elevated as investors' anxiety is elevated. But as I showed you on that first slide, that anxiety is not met with actual market performance. Actually, the market performance is better in the election years and the year after the election, regardless of who gets in the office on average, than the stock market as a whole. Stock market seems to be very confident that the lower interest rate environment is going to favor corporations, particularly corporations that do a lot of capital investing and they need debt to do it, that their cost of funds will be lower. Our confidence is more guarded, right? Because it's just the short end of the yield curve environment where interest rates have gone down. As I mentioned earlier, the longer end has remained the same, or actually drifted up slightly. So we think the stock market is actually discounting the effect of lower interest rates at the cost of being overly optimistic for the reasons for the Fed cuts in the first place, which is because the consumer and the economy is slowing down. Our positioning in terms of allocations in the equity market is more broad-based. We do have exposure to small and mid-cap stocks, those lower ones that you saw on the previous page, but are doing better as of the most recent couple of quarters. So it's more broadly based, more defensively positioned, if you will, in that respect. We also have allocations outside the United States, predominantly in developed foreign countries, where valuations are better than they are here in the U.S. The bond market, the short end, as I mentioned early on, comparing the Fed funds rate to the two-year Treasury, seems to be fairly valued. We don't have as much confidence in the longer end being fairly valued. We think the longer end is overvalued. We don't think the overvalue is due to the prospect of a recession on the horizon, at least not as things sit today. We could make an argument for a slowing economy, as I mentioned, when the consumer is struggling a little bit, but as long as deficit spending remains at the levels that they're currently at, the prospect of a recessionary environment without some sort of catastrophic event that's unexpected, right? We just saw that in the pandemic, unexpected, the great financial crisis, unexpected, right? We can go back throughout time and pick on some unexpected events that have caused an economic slowdown. But economic growth in itself tends to not die of old age. There's something unexpected that comes up. We don't know what that would be right now. Maybe it's deficits. Sometimes these unexpected events are actually in plain sight. You've heard a lot of talk about federal deficits. How much is too much? I don't know the answer to that question. Our combined federal deficit right now is running at about 120% of GDP. A lot of times you'll see headlines that say 100%. They exclude Social Security. I tend to exclude the deficits created by Social Security, so those are about 120%. Where does the whole system start to break down? I don't know. Japan, for example, is running deficits close to 300% of their GDP. So maybe it's not a catastrophe at 120% of GDP, but maybe it is somewhere around 300% of GDP. So a whole host of other topics about how Japan runs those levels that maybe we don't have the same environment for, but be that as it may, we are positioned defensively in this environment. So with the idea that long-term yields are overpriced, our duration or average maturity exposure is less than most of the popular fixed income benchmarks out there. We're still doing better than those benchmarks out there, so we can consider ourselves fortunate. So we're defensively positioned in the bond market. broad market position in the stock market, not making any adjustments in the portfolio allocations because of the potential outcome of the elections. Thank you for joining us today. Hopefully this has been a benefit. Wishing you a great fourth quarter, and I probably won't see you again until after the holidays, so wishing you happy holidays as well. Bye now.